Okay, welcome everyone. Once again, thank you for taking the time to be here this evening, this afternoon. Some folks are all over the world, whether it's morning, I'm not sure, but I'd like to thank you all for being here. Once again, my name's Jim Penna. Uh, I'll give you some of my background in a moment. It's great to be here. I'm very excited for this webinar. As the room continues to fill up, if you are new to GoToWebinar, we do have the control panel here. If it's broken down, you'll see this orange box with the white arrow. Just click there and it'll open up the control panel for you. And then right there in that chat box, you'll be able to type in any questions, comments, or whatever you have going on there. So folks are still typing in. Eleanor is in Melbourne. Um, Tyrone says it's 15 degrees below zero in Toronto. Yeah, Blue Jays aren't playing any home games this week, right? All right. And Jim's here from Missouri. All right, great. I'm very happy that you guys are here. I hope everyone is staying safe and healthy. And I want to jump in because there's a lot of good information here. I don't want to I want to get right to the three core strategies to protect and grow your retirement nest egg. Okay, as we do that, just a quick introduction here. It's better if you turn off as many distractions as you can. I know your phones are on put them on vibrate, close any doors, try take some notes, do whatever you have to do. I think there's some good information that I'm going to share with you. Now, I promise I'm going to give you everything I can during the next hour or so to introduce to you again the VectorVest uh, techniques of building and managing your retirement portfolio. At the end, I'm going to show you where you can go to get some more help because, of course, we want you to be able to implement these things and get some results as quick as possible. So, with that, again, my name's Jim Penna. I do see a couple of few familiar names in the chat box. For those who are new to our webcasts or to VectorVest, again, I'm the manager of retirement services. I've been with VectorVest for about 14 years now. Prior to coming to VectorVest, as I said, I lived up in Connecticut, New York area. I worked on a trading desk for a large firm as a market maker, and some smaller brokerage trading desks before that, before moving my family down from what's going on up there now, from the cold weather. So that's how I got here. So it's been a long time. I took my Series 7 back in 1992. So I'm doing this for a while, as you can see by some of the gray hair. So before that, I like to just say in a previous lifetime that I was a police officer up in Connecticut. So at any point during the webcast, it starts to sound like I'm telling you what to do. It comes from that comedic pause. Hard to make jokes on a webcast. You never see the audience stuff. Hi Mira, how you doing? I hope all is well and that you're doing okay. All right, I am also just one of many on our education team. Miss Linda Royer, Mr. Don Payton um, uh, are the upper management, and this is our education team right behind. So I'm just one of many, and we're always working together to bring you the best that we can. So let me go ahead and get started here. And I found this screenshot. I'm always looking for screenshots that help me convey the different things. Sometimes words aren't enough. That's why we have this slideshow up sometimes. And I found this just yesterday. It was a last minute addition here. I saw this little thing here, success, what people think it looks like and what it really looks like. And I thought that was a good start to what I want to talk about tonight. Now, I can't guarantee you if you're just, new to some of these things or just starting out, or even if you're not new to it, but are just looking for ways to be successful in building and managing your portfolio. I can't promise it'll be that easy. I certainly wouldn't promise that. But what I can tell you is that I'll do everything I can to unwind these tangles here a little bit, right? So that we can be successful as we build and manage and protect our portfolios, our net worth, as we go forward. Okay. The ultimate retirement solution is kind of what we call the umbrella under which the retirement services department is, and a lot of what we do at VectorVest, right? And so through a conversation that I had with our founder and mentor, Dr. Bartolito, more than a few years ago now, I had said to him that my interaction with our retirement minded subscribers, whether it was at our live seminars when we went on the road, emails, phone calls, whatever it might have been, that the conversation had always led back to, in one form or fashion, back to the question of how do I keep from running out of money in retirement? Okay, in some form or fashion, of course, that's everyone's concern. And I'll never forget, he said to me, only the way Dr. D can, he said, James, just tell him to keep making more money. And so that ultimately became what we call the ultimate retirement solution. Now, there's a lot that goes with that, of course, but it was kind of the beginning for a lot of what we do. So it's our mission here at VectorVest to do our best, to do my best as manager of retirement services, to assure you that you can retire with peace of mind, knowing that you can steadily grow your retirement, that you can generate a safe and steady income, and to me, most importantly, is to preserve your capital, to protect your net worth. To me, that's the most important of the three core strategies. Okay, we define a secure retirement as one in which you have enough income to live the life that you desire, where work is optional and retirement is affordable. And it's a pretty straightforward plan. A lot of the headlines with all the trading that's going on and the Reddit and the Wall Street, whatever they're called, GameStop and all that stuff, it's taken over the headlines. But for now, I want to take it back to a basic technique, a straightforward technique, but one that is known to work, and that's what we're going to focus on. We start with a foundation that our goal is to, again, peace of mind is a big part of what we're trying to do. We call it the three P's that I'm going to place up here: profit, provide, and preserve. Right? These are kind of the three core strategies. What do we mean by profit? Well, as we allocate our assets for retirement, we're talking about assets that are designed for the equity markets, right? There are other alternative investments. There's bonds and there's other things. There's a lot of things you can do, but we're talking about that part of your retirement nest egg that's dedicated to the equity markets. So when we say profit, we're talking about building a portfolio of buying good quality, safe stocks at the right time that are rising in price and that will grow your portfolio. We're also looking for a portfolio or stocks. Listen, we know nothing goes straight up. Although watching the market since March of last year, we have to be reminded sometimes, and I will later remind you that the market doesn't always go straight up. But what we don't want are those violent drawdowns where we have to wait months and months just to get back to even. So we want to take that big roller coaster ride out of your investing and turn it into a steady climb. When we look at the provide side, what we're talking about is providing income, whether that is through a strong dividend growth portfolio or with the use of covered calls. Okay, so we want you to be able to not have that random stock where you get a few bucks here and there through a dividend paying stock. We want to take that and shift that into a steady flow of income into your portfolio. Now, before I get to preserve, I want to talk about the idea of, I mentioned covered calls, and I'm also going to talk about put options as a protection or insurance in your portfolio. I'm not going to get all into that yet, but I want to say this now. You heard me say covered calls. Yes, we're going to talk about selling covered calls to generate income. I just want everyone in the room to know that I don't know if some folks may be familiar with options, some may not be. What I want to tell you right at the outset is that in no way do you have to be some type of options expert or, understand or have been trading options to implement what I'm going to be talking about today in our session. I just want that to be clear. A lot of folks hear options, they get, their hands go up, they step back and say, well, wait a minute, I don't trade options. Stay and understand how simple and easy covered calls and protective puts are. I believe they are necessities. If you're here to build and manage your retirement portfolio, it is my opinion that understanding the covered call and protective put are a necessity for you. And so we're going to make it straightforward. We're going to stick to only those two concepts. So I just wanted to get that out of the way now because it is going to play a part in that next important part that I'm talking about, which is preserve, right? We want you to go from being unprepared and not knowing what to do when the market turns against you to being ready, to being prepared, to be strategically defensive to protect your net worth. The great hedge fund manager Ray Dalio, paraphrase a great quote I read from him, and that is he said that you can't make money without taking risk, right? Every time you hit the enter button to buy even the safest stock, you're taking some type of risk. But he said you can't make money without taking risk, and you can't keep your money without being defensive. And so that quote has stuck with me for a long time, and it makes a lot of sense, right? What good is making the money if you don't know how to keep it when things start to go wrong? So um, that's our goal. That's the foundation of what we're doing. So when we break it down, again, we're talking about capital appreciation, income, and capital preservation. And let's get started with capital appreciation. Okay. Starts with profit. We say that capital appreciation comes from owning companies with consistent and predictable financial performance. And I always say, what two better adjectives to define or describe the type of stocks that are in your retirement portfolio better than consistent and predictable? Okay, you're going to hear me use some sports analogies throughout tonight, right? So my next slide is based on a quote from Dr. D. Dr. DeLito has written and said many times, good portfolio management starts with buying the right stocks. And that's my underline there because that's the first part of building and then managing your portfolio. I use a baseball analogy, and you could put whatever team you want, whatever sport you want. But again, I grew up in Connecticut, not too far from Shea Stadium, so I was a big Mets fan, or still am. And I use the analogy as if you think about you're the manager, right? You're Gil Hodges, and you have to put out onto the field the best team that you can. So you get guys like Tom Seaver and Jerry Kuzman and Cleon Jones, Tommy Agee, right? You put the best team that you can out on the field. It's the same thing with your portfolio. Okay, using uh, a technique or a system that puts the very best stocks in your portfolio so that you can have a winning portfolio. So that's the idea that we use here. And so we say that it all begins by investing in safety first. In other words, for our retirement account, primarily this portion of it we'll refer to as the growth portfolio. You want to look primarily at a company's safety more than anything else for the type of investing that we're going to do. So again, to continue the baseball analogy, while it's fun to hit a home run, right? Again, the headlines were taken over for a couple of weeks there with all this crazy trading. And while it's fun to hit the home run, we all know, most of us know, what a home run hitter does when they don't hit a home run. I know somebody will type it in for me into the chat box. Right? What does a home run hitter do when he's not hitting home runs? Generally, right? It's more so these days than back then. Right? Yeah, they're striking out. Exactly. Robert had it. They're striking out. That's not what we want to do. So in the VectorVest program, we have what's called relative safety. It's a proprietary indicator. It's defined as an indicator of risk. And again, consistency and predictability are the primary factors in assessing relative safety. Okay, very quickly, all with the exception of one indicator that we use, and I'll talk about that, are all on a 0 to 2 scale in the VectorVest program. Dr. DeLito created the formulas for this, for relative value, relative safety, relative timing, and they're all on a 0 to 2 scale, and they allow us to compare different types of stocks, right? So we have a fair comparison on when we're analyzing stocks. Okay. Relative safety specifically has a lot of fundamental information that we receive and is funneled into the VectorVest program. And as it comes through the program, it is then funneled through Dr. DeLito's formulas that give us the VectorVest indicators. And specifically, I'm talking right now about relative safety. Okay. So you can go out and get a lot of the information. I'm going to talk about it in a minute. Just a quick stock safety checklist is what we call it. I'm going to talk about very briefly what goes into relative safety. Now, you can go out and try to do the research on your own. It can be a very daunting challenge to even come close to the amount of information that's available with just this one indicator. Now, I'm not going to spend a lot of time and go through too deep. I could do a whole hour just on this. But just know that these are the factors that go into the relative safety formula. And just a couple that I'll talk about really quickly are earnings consistency. Of course, always earnings is what drives an individual stock and which in turn drives the overall market. Right? So earnings are always the most important. Does the company make money quarter over quarter, year over year, consistently? Company size and price behavior are part of it. How long has the company been around? These are factors and formulas that go into it. The last two are important. Dividend history. Now, for a stock to have a high relative safety number, it does not need to pay a dividend. Right? In fact, a lot of high RS stocks don't pay a dividend. But the important takeaway is if they do, they darn well better continue to pay the dividend on a regular basis and grow that dividend. Because as Dr. D says, there's no greater black eye for a company than to have to either suspend or cancel or cut their dividend if they pay it. So that's a big part of it. And finally, debt to equity ratio. It's just a great indication of does a company have the ability to withstand any headwinds or issues, whether it's economy related or directly related to their company. Is it a favorable situation for that company to make it through the harder times? So when you hear me say there's an RS on a stock of 1.48, which I'm going to show you right now, okay, I just take the extra couple of minutes so that you understand that it's, what exactly goes into that. Right? It's easy for me to say, oh, it's great, it's got a high RS. But just understand that there's a lot that goes into that. Okay, and here's an example. West Pharmaceuticals. This just as of less than a week ago, I took a screenshot of West Pharmaceuticals. It is obviously a high relative safety stock, 1.48. I use West Pharmaceuticals as a stock I own in one of my retirement accounts. And what I have here is a 5-year look back on the stock. And you can see earnings per share steadily growing and rising. VectorVest uses a combination of historical and forecasted earnings. It's a very unique way, but you've got earnings that are rising, and then you've got a stock that's also rising. And my old saying is that it's not a coincidence that as earnings per share rises, so too does the price of the stock, and we get this northeasterly direction on both earnings and the stock. Okay. Now I could show you 15 different graphs of high RS stocks, like I used to do it in some of our presentations, but I think you get the picture. I don't have to go through 15 different graphs. Just know that high RS stocks generally, not everyone, and they're all going to have their drawdowns and their pullbacks, but generally that's what we're going to see. I added dividends to the subgraph here as well because West Pharmaceuticals happens to be one of those high RS stocks that does pay a dividend. And this is just a 5-year look. I'll illustrate another stock in a moment. We'll go back 25 years. And we can see that the company has grown its dividend. Well, West Pharmaceuticals has done it for 25 years, over 25 years. Okay. But I just like to show that golden staircase. This is the visual of what we're talking about, a growing dividend. Okay. So these are the kind of stocks, and again, there are dozens I could bring up and show you, but what I'll do instead is take you into the Unisearch tool here as our scanning tool, into the Unisearch tab up top, and it brings you to our list. We have folders here, our search directory, and we categorize different types of stocks. Here I'm in what's called the prudent folder. My favorite search in the VectorVest program is called ruler stocks. Okay, ruler stocks, and in the program it'll tell you, generally what type of stocks the search is looking for, but you'll see relative safety plays a huge part. Just to make the list on ruler stocks, the stock has to have an earnings growth rate of at least 14% per year. You can see the earnings. This is GRT, stands for earnings growth rate in percent per year. And then just to make the list, the relative safety number has to be at least 1.4. And then to top it off, we sort them with the best combination of relative safety and growth rate coming to the top. Okay, and so we have, Tesla is at the top. Now, I did this presentation last couple of times I've done it. Tesla is at the top. It is an over before anybody types in, just real quick to talk about this. It is in our program an overpriced stock, right? The current value of Tesla is at 166. So people say, how could it be a buy rated stock, have a high relative safety number? Well, the value is just a snapshot in time. Okay, it gives you the current value of the stock. When I see an overvalued stock, the first thing I do is I go to this column right here, the earnings growth rate. And the reason it's a high relative stock, high relative safety stock is has a lot to do with that earnings growth rate. Okay, what you'll see most of the times is a stock with a high RS also has high comfort index, which I really didn't talk about, but that's what we call price growth persistence. Okay, and a high relative value, which is price appreciation potential in the VectorVest program. So it's not on every high RS stock, but usually the numbers we care about will fall into place when we look at high RS stocks. And I'm sure you're familiar with all of these companies. I would imagine that at the top of the list. This is just from Friday's close. Ruler Stocks is a great search. It's not the only one. Long-term winners is found in the retirement search directory. Very basic search. What it does is virtually take the entire database. With a few exceptions, it takes out pink sheet stocks and stocks that don't trade much, but otherwise, it's just sorted by relative safety. And you'll see even higher relative safety numbers here come to the top of the list. Okay, so long-term winners, another great search. Worry-free winners, also sorted by relative safety. Here we put a technical indicator on this. The 50-day has to be above the 150, and the stock has to be a buy-rated stock just to make it on the list, and it also has to pay some type of dividend. So these are just a few of the searches that we have among many that we have here in our program to find these stocks. Okay, I think West Pharmaceuticals was on one of these searches. I thought maybe it's in the other one. So that's what we have. How do we find these stocks and how do they perform? I'll talk about in just a second. Okay. What I have here is if I use an example of a growth portfolio focused on high safety stocks, I use one that's called, again, I'm using Ruler Stocks here. PLP Customized is the Profit Locker Pro risk management plan that we have behind it. I'm not going to go all into the exact settings on it. Just understand it is a prudent/conservative management technique. It allows the stocks room to draw down if the market moves sideways or turns against us. It's got reasonable stop criteria and it manages the positions really well. It started on January the 3rd, 2017. It started as a 3-year model, and then a 5-year, 3-year, and then 4. Now it's in its 4th year. It's part of our retirement coaching group that meets every Tuesday, and we continue to manage it. It's currently up right about, depending when I took the screenshot, 140%. This was just a few days ago. Okay, these are the current positions in the portfolio. And if you look at it at 140%, which is just about 4 years and a month and a half, right? 4 years and change. We're at currently a 34% annualized rate of return. Okay. Now, I know we see the drawdown here. This was the pandemic sell-off. I'm going to talk about how to mitigate that drawdown in a little bit. But a 34% annualized rate of return, I'm sure many of you, your first question is, well, how did that perform against the overall market? Okay, a lot of us here at VectorVest, when we say the market, we'll talk about the VectorVest composite price. Generally, for our purposes and the type of stocks, I'll talk about the S&P 500, and you'll see 74% over the exact same time frame as of Friday's close. 18% annualized rate of return. I mean, that's the overall market. Well, we've basically doubled it. Not quite, but just about doubled the performance with a prudent risk management system and good quality, high relative safety stocks. And again, I'll talk about this drawdown and how to mitigate that in just a few. So I'm just going to ask, just so we stay, I want you guys to interact with me and stay with me. So I'm going to ask real quick. Again, we know nothing goes straight up, but would you rather manage your portfolio and live through these roller coaster type moves that we know are going to come? I know the market's been going up. Or would you rather implement a plan that had more safety and had a smoother, steady climb? So I'll ask you to either type in no for no safety or safety. And I'm going to take a quick drink of water and ask you to type that in. Okay, I promise that was water and not an adult beverage. Everyone is typing in yes, safety, 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 safety. One person typed in no. Long typed in no. Maybe you misunderstood the way I phrased the question, but I knew the answer. I just want you guys to interact with me. I knew what you'd say. But yeah, we want that steady climb. I want it to be safer, understanding that yes, there'll be some drawdown, but I want that steady ride. All right, great. All right, that's capital appreciation. What I'm going to do is shift gears here and talk for a moment about income. Okay, so we're talking now about a different objective, a different mindset for what we're going to do next. When we talk about, again, this is the second core strategy of building the portfolio. It was the provide part of that little pyramid that we had. Steady income flow from dividends and covered calls. This is part one. I'm going to spend a couple of minutes talking about a strong dividend growth portfolio. Right? We want to get paid, in other words. If you Google good dividend stocks, and if you just try to do this on your own, what the big mistake a lot of folks will make, and understandably so, is they'll start to look at the current dividend yield of a stock and say, well, the highest yield must be the best dividend paying stock, and it's just not. It's just not the way it works. Okay, whatever site you go on, dividend, you'll always see that they're always sorted by the dividend yield, which tells me nothing about the quality of the underlying company. And so I revert back to VectorVest. And what I have here in the Viewers tab of the VectorVest program, we have our watch list viewer. And these are watch lists that are built in. You can build your own as well. And I just started with the DRIP 25 plus. Well, what does that mean? DRIP stands for Dividend Reinvestment Plan. And we have 10 to 24, 25, etc. We even have master limited partnerships, MLPs, that are closed-end funds and ETFs. We even have monthly dividend payers. But I come here because this is the list that most folks will go to first. This is the list of stocks that has not only paid, but has grown their dividend every year for at least 25 years. Right, a lot of folks know the term dividend aristocrats. Technically, dividend aristocrats is stocks that have paid or grown their dividend every year for 25 years or more that are part of the S&P 500. Not all of these stocks are currently. Some have been and then maybe left or came back to the S&P. But these are stocks that have grown. And here at West Pharmaceutical, again, this one's a little older. This screenshot does go back to August, so this was an older screenshot. But West Pharmaceuticals is on this list. You can see back then the relative safety was 1.46. Excuse me. I'm sorry, I had to cough there. You see the high relative safety, the numbers here, the growth rate and all for West Pharmaceuticals. Lowe's, a long time, top of the list here for this one as well. So here we're just looking for this long history of dividend growth. Okay. Now within the VectorVest tool and the Unisearch tool, you have also the searches that will help you find good quality dividend paying stocks. And I'll just share a couple of them with you. One of them is pale blue chips, just another old favorite of mine. This one's found in the conservative folder, and I won't go through every indicator here, but just know one of the indicators is that it has to have a relative safety of 1.25 or greater. And then what's great about this search is that it looks at all of our dividend indicators individually here, right, with parameters on growth, safety, and the yield, the growth rate, and the dividend growth. So I like the idea that it does that. And what you'll see here again, because of the RS parameter there, you'll see good RV numbers. RT depends on the market, right? This was taken as of Friday's close. We know the market has been soaring, so a lot of the relative timing indicators are strong here. But you'll also see high CI numbers. And then these, when we talk about dividends, are the important indicators for us here. This is dividend growth, okay, the dividend yield, and then here's dividend safety. Dividend safety is the one proprietary indicator that's not on the 0 to 2 scale, it's 0 to 99. And what we look for in dividend safety, as I'll show in a moment, is greater than 50. Right? High RS stocks will have a much higher dividend safety number. Okay, but anything above 50 we consider to be favorable. Okay, so we have the dividend, the actual dividend paid here, and then the dividend yield as well, to look at. And then finally, dividend growth, safety, and yield go into one vector called the yield safety growth vector, and that's of course is on a 0 to 2 scale. We prefer to see that above 1. So pale blue chips is a great search. Again, recognizable companies. I'm sure you recognize most of these. T Rowe Price is on there, and I'm going to talk about T Rowe in a minute. Another great search, blue chip dividend payers. Now this one is a little different. Okay, this is the one we use as our model in our retirement coaching group. I created this search, and it is very basic. Okay, to make the list, it has to be Dow Industrials, Transports, or Utilities, or the S&P 500. Has to be on one of those exchanges. The dividend yield has to be at least 3% or greater, and it has to be from the DRIP list, either 10 to 24 or DRIP 25 plus, because I want a history of dividend growth. And so we have it right there at our fingertips. And then dividend safety has to be greater than 50. That dividend safety tells me I have a favorable payout ratio. And just real quick, what we mean by that is, does the company, right? So a poor payout ratio would be if a company earns $1 a share and pays a dividend of 2.25 of an annual dividend, and their earnings are $1. Would that be a favorable payout? And the answer is, no, right? Because if the company's not making enough money to pay their dividends, how long will that be able to continue? That's not what we're looking for what we're doing here. Okay, so again, we have our dividend information. Now, the first thing you should have noticed is that the relative safety numbers here are not great. Okay, because as I said, we shifted gears a bit. Pale blue chips has them, but again, I know you recognize 99% of the stocks here. These are mature companies with a strong free cash flow that chooses to pay out their shareholders through dividends. Right? So that's the type of search we're using here. T Rowe Price was on that list. There's another. I just use one other company that I own in one of my retirement accounts, and this is the 25-year look. VectorVest has the ability to go back that far, and again, I like to call it the golden staircase. Right, you just see it continue to rise year over year, and then again it flattens out because it's 25 years, but you get the picture here. Okay, remembering these are $50 increments on the stock, and again you can almost, without even looking at the calendar, when you see these, I know when these occurred. Right, I know this was October of 2018. This was last year. This was 2008. So you can almost, so it's like a calendar, some of these graph patterns. So as I did with the growth portfolio, if we take a look, now this is a longer term. This is blue chip dividend payers. Again, this one uses just the Profit Locker, not Profit Locker Pro. Actually, I have two portfolios. This one uses, I believe this one actually may use Profit Locker Pro. But again, it's nothing more than a very boring, very practical risk management technique. There's not a lot of trades that go on. There are trades that go on, but not a lot. Okay, and again, I'll talk about mitigating the drawdown that we saw in February and into March of last year. But here we have 154% return. This one's 8 years. This one also started as a 3 year, then 5 year, and I continue it as a model to convey the importance of the longer term success of these. These are the current positions. So again, if I do the annualized rate of return, 19%. Okay, what that does not take into account are the dividends. Now, up until about maybe 2.5, 3 years ago, I would calculate for the life of every trade in here, and you can manage your portfolio and manually enter the dividend payouts. I did that for a long time, and then I got tired of it. So at that point, when I stopped, it was about $33,000 of dividends that I had calculated. So I'm saying that we have roughly 40,000 now. Add that to the 154 gain that we've had, and we're just under 200% return. Okay, so this 19% does not include these dividends. When I include those dividends and turn it up to roughly 195,000, give or take, it's a 24% return. So again, you'll ask yourself, well, how does that rate against the overall market? Now, the overall market is 20% annualized, so it beats the raw performance, but add in the dividends, and that doesn't even include the dividend reinvesting and the power of reinvesting those dividends. Okay, which can be monumental. It's amazing what you can return in the dividends. This is the current portfolio. You can see all of the current balances here, return on investment, gains per share. Again, the best, remember I said consistent and predictable for the high RS. Well, here, this portfolio, and I say it in the most admiring way, it's very boring and it's very practical, and it does a great job. So that is our income dividend growth. Okay, I'm going to switch gears once again within the income or under the income umbrella. And I'm going to talk for a few minutes about covered calls. Okay, to me, well, let me first say this. Covered calls is the most popular option income trade. It's the easiest income trade to implement. Okay, and if you're looking to allocate assets to, again, a safe, steady income, covered calls is the way to go. So part two of providing. Let's talk a little about covered calls. We look at it as charging rent to stocks that reside in your portfolio, right? If I own a covered call, if I own a stock and I sell a covered call against the stock, I'm getting paid. I'm selling something and I'm getting paid for it. Okay, let me make that a little clearer to you. Here's a quote from a gentleman named Lee Lowell. He wrote a book called Get Rich with Options that Dr. DeLito had read a long time ago and passed on. We used to sell it on the road when we did our seminars. And it is still to this day, I've been using this definition for years now, the most straightforward, the most basic definition of what a covered call is. And I've highlighted it here. You can read through it or you can get the book. But Mr. Lowell says there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Okay, that is the most clear definition of a covered call that I can find. He goes on to say selling covered calls is a great way to pad your bank account. Can't believe there are investors who aren't taking advantage of it. And frankly, neither can I. So my goal is to help you take advantage of it. Quick description or definition. It is a covered call, the simultaneous purchase of an underlying equity and the sale of a call option of the same security. It's also known as a buy right. Right? When you do it simultaneously, it's called a buy right. You buy the stock and you sell the call, or you write a contract. Selling and writing in this case are synonymous. Right? Buy the stock, write the call, all in one click of the enter button. You set the trade up that way. Of course, you can also sell one option against every 100 shares of stock you already own to generate income on stocks you already own. There's a lot of reasons to sell covered calls as a defensive measure. Um, I won't go into too many. I'm going to focus mostly just to lay the foundation of a buy right. Now, I said earlier, this is not in any way an options course here, but I'm going to give you just the basic definitions of a call option. It's a security. It trades just like a stock. Options trade just like stocks. There's a bid price and ask price. There are market makers who are tasked with providing a fair and orderly market, just like a stock. So a call option is a security that gives the buyer the right to buy a stock at a certain price on or before a certain date, right? Like any contract, it has strictly defined terms and conditions. Those strictly defined terms and conditions are the certain price, which is a strike price, and an expiration date, at which point the contract expires and goes away. So if you're the buyer, you pay out money and you take on rights, right? You paid something, so you got to get something for it. Now, as the seller of a call option, you're obligated to sell or provide that stock to the buyer at a certain price by a certain date if that buyer chooses to exercise their right. Okay, so that's the difference. We're talking about being a seller of a call option. Now, if you sell what's called a naked call, it's a very risky trade because if the stock goes up and you are what they call assigned or somebody calls away the stock from you and the stock takes off, you have to go out in the open market and buy it at a higher price and provide it to the option buyer at the strike price, which would be much lower. The loss is unlimited, potential unlimited. But for our purposes, we're selling a call against a stock we already own, so hence the name covered. Right? We don't have to go out and buy it, we already own it. Okay, so that's a very quick version of call option and the seller of the call. I think you guys probably watched the Super Bowl. I hope a lot of you did. Maybe everyone won't get this, but if you remember, Tom Brady and Tyrann Mathieu had words near the end of the first half there, and there several times they were arguing. Right? They were arguing, yelling at each other. But what people don't know, I happened to get the insight on NFL films. What they were actually yelling at each other about was this: Tyrann Mathieu was actually a call buyer, and he was yelling at Brady that he wants to exercise his call option. He wants to go out and he wants the stock because Brady sold the call option. So Brady was yelling at him, fine, you got to pay me the strike price first. And this is what they were complaining about. This was a last minute entry into this presentation, Robert. At least I got one laugh out loud, at least. Anyway, this is what these guys were arguing about, right? He was the call buyer. He was exercising his rights. And so Brady now has to provide the stock and he has to pay the strike price. All right. That's what they were arguing about. All right. Let me break it down in this fashion here for you, again, assuming that you may be new to covered calls. Here's what it would look like. You go out, or let's say Brady went out and bought 100 shares of XYZ and paid $60 per share. As a buy right, simultaneously, the buyer sells one XYZ call option with 45 days to expiration. Usually the window is 30 to 45 days. And the strike price, that certain price named in the contract is $62.50. Right? Certain price by a certain day. And remember what Lee Lowell said. Somebody's willing to pay you $2 to take your stock away at a higher price, which in this case is $62.50. If that trade is done, then what happens is your cost basis is lowered. Right? So now you really own XYZ at $58 a share. This $2 is yours no matter what happens. That $2 is yours. You own the stock now at $58. So what I want to talk about is kind of a what if situation. What if at expiration XYZ is above $62.50? Well, what will happen, and it could happen during the life of the trade, doesn't have to happen at expiration, but someone can exercise their right and take the stock away at 62.50. Well, you have to look at it this way. That's a great thing if that happens. It means you had a successful covered call or a buy right trade. Because what happens, remember, you own the stock at 58. It's called away at 62.50. That's a $4.50 profit or 7.5% return on investment in just 45 days. Right? We talked about dividend stocks. What if you had a dividend stock that every month paid you a 7.5% return, or every month or 45 days or so? You'd be pretty excited. Now, what if XYZ is below 62.50? Well, at expiration, remember, we built a cushion. The $60 stock really cost us 58. In this case, it's 3% lower than the original price. As long as it stays above that break even, we don't lose any money. So we built, in this case, just a couple of dollar premium, or cushion, I should say. And then finally, if XYZ is below 58, losses will begin to occur because you have to remember, a covered call is a bullish trade because you own a stock, right? You're long the underlying equity. And just like any stock, if it begins to fall, losses will occur. The beauty here is that you have a built-in cushion and that we do have risk management techniques to manage the trade once we're in the trade. But this is how a covered call works. Okay, I have a screenshot from our Options Pro software just to give another view of what it looks like, right? So, you know, at expiration, remember your profit is capped here. So in this case, on Micron Technology, if you bought 100 shares at 82.88 and you simultaneously sold the 85 strike, giving someone else the right to take your Micron Technology away at 85, and they paid you $3.14 to do that. So our max profit, if it works out perfectly, is 526 bucks. That's 314 plus the, what would it be, $2 and 98 12 cents. Am I doing the math right? $2.12 capital appreciation would give you $5.26 profit, and for one, this is just 100 shares in one contract. Okay, it would be 526 bucks, which would be just over a 6% return on investment. You know, in somewhere around 30 to 45 days. This was an actual trade. This has now since been closed for a profit of about 425 or 30 bucks. But this was an actual trade that we had in our Tuesday group coaching that was just closed out at a nice profit. This is a covered call spreadsheet. Don't be alarmed by what you see here. I'm just showing you something here. Uh, the power of covered calls. This is the year 2020. This is a diary. It's just a diary I keep for my covered call trades so that I can track them. It's easier than going into your broker's account all the time. And what you see here, I have highlighted one stock, AMD. Throughout 2020, we did 8 trades on AMD. Once a week, we'd go out, assuming the market was favorable, right? Had to be a green light in the price column or some indication of a rising market. And I just highlighted these just to show you that among 38 trades that we did last year, 8 of them were in AMD. Okay. They were all profitable. Not all of our trades are profitable, but I can tell you real quick from this spreadsheet that we had 80% winning trades and just, I'm going to call it 25% return on investment for the year. 24 and change, almost 25%. Okay. Don't worry about what these numbers are showing. I'm just showing you where what I'm going to show you now came from. That's all I want to do. Okay. And to do this, we have a very specific management technique that we use. So we rarely hold these to expiration. I want to share this because it was and this actually happened in 2019 as well. So I'm going to walk through this and show you basically what we just saw. I want to give you a visual of what you just saw on that spreadsheet. Started in February. I don't have all the exact numbers because I just don't have time to go through everyone. We bought 200 shares of AMD. We sold 2 covered calls. 14 days later, we closed it at a $538 profit. That's 14 days, we made 5.97%. Our process, our system had some other trades going on, but on May 5th, we did it again. Using our process, AMD became our next candidate. 9% in 35 days, $894. We did it again not too long after that, bought 200 more, and then we sold them and had a $616 profit. 6%, 24 days. Again, if you had a stock that paid you a 6% dividend every month, you'd be pretty happy. We did it again in August, another 7%. And you can see we're using market trends and timing. We did it again in September, just 20 days, another 7.7%. Again in November, this time only 14 days, another 6.6. And then finally, we did it there. That was a quick one, only 8 days before our system stopped us out to our profit target. It only took 8 days there. And then finally, we did one at the end of the year. Technically, it closed on January 11th, but we placed the trade there. That was another 7% in 34 days. Okay, if you add all that up for the trades that were initiated in 2020, just on this one stock alone, this doesn't include the other trades, $7,300. Okay, again, we had 80. Not every trade's a winner. If you ever at a webcast or a seminar and somebody tells you they have 100% winning trades, what are you going to do? If you're sitting down and someone tells you you have 100% winning trades, what should you do? Yes, Michael, thank you. Michael, in capital letters, wrote run. Yeah, I'll never sit here and tell you have 100% winning trades ever. But we did have 80% winning trades. And this is just one example I wanted to use to illustrate to you. So again, 80% of these trades were winners. And I just wanted to share this since I showed the other one. This is for 2021. We're off to a good start. We have 3 open trades. AMD, again, is in there. Right now, profitable. Again, we have a certain technique to indicate our profit targets. And we have 2 closed trades already that are profitable this year. So that's where we're at for our income trades. Okay. Nick's asking, any broker fee on covered calls? Yeah, there is a small fee. You don't pay to buy the stock, but usually there's a commission on options, $6, $8, whatever it might be. And you can do these in your IRA accounts and 401k accounts. As far as the RRSP, I believe you can. I don't want to quote me on that one. Okay, this is just for this year. These were closed trades for this year. NEO and MU. That was the one I just showed. $421 was actually our profit. But I used that screenshot just to show you. HZO and MU came back in again. Okay. All right. Okay, Sanjay's asking what were they purchased at? All different numbers, right? We didn't just buy AMD and hold it. We have a system that closes the trade and then reopens it. It's a very specific system that I don't unfortunately have the time to go through exactly right now, but you got to have a technique. You have to have a process to do it. All right, let's talk about capital preservation, and I'll finish up here. It's, again, I believe the most important strategy is the third core strategy. We talk about preserving your capital, protecting your net worth using protective puts. Again, if you don't trade options, understand it this way. Protective, use the word protective is very instructive here. It's insurance, right? It's an insurance policy. That's all it is. As I said earlier, I like to find quotes and pictures and things. My fellow Connecticut Yankee, Mr. Mark Twain, once said, don't just sit there and worry. Be proactive. Do something, anything about what's worrying you so you can gain information, focus, and control over the situation. I think that's just a great quote to talk about what I want to, when we talk about capital preservation. Be proactive. You have to be strategically defensive. Okay. I mentioned earlier, we talked about worry-free investing, and there's a search called Worry-Free Winners, and it's great. But listen, I worry about everything when it comes to my accounts. Right? I'd be lying if I said I didn't worry about it. Even high RS, I worry about everything. That comes from my old cop days. I think I still, you know, peek around corners and look over my shoulder all the time because I worry about everything. And you should, because you need to be proactive. Because if you don't, right? Here's the guy or gal who had a boat and said, "I don't worry about everything. Everything's fine." And here's what happens. Right? That's what happens when you have no worries and you don't attend to things. Okay, reduce risk. Insurance. You buy put options to protect your individual stock positions, or you can do it for your entire portfolio as well. I put option collars on here. I'm not going to really talk about those, but it's another way to combine protective puts and covered calls. And you can kind of Google or look that one up. But for now, I'm going to focus just on protective puts. In other words, what we want you to take away here is the importance of protecting your assets. The best way to do it is to look at it this way. All you're doing is getting an insurance policy for your stocks, for your portfolio, or for individual stocks. You insure your home, your car, your life, your health. Heck, my wife and I, we have insurance policy on our two dogs. Okay. Think of it, protective puts as the same thing. All you're doing is buying protection in case an asset that you own is damaged. So put options convey the right. Here's the definition of a put. Unlike this is a mirror image of a call. A put option conveys the right to sell units of 100 shares of stock at a certain price by a certain date. So if I buy a call, I have the right to buy the stock. Here, if I have the put option, where the name put comes from, I have the right to put the stock to someone else at a certain price by a certain date. If the underlying stock falls, let's say you have a stock that's trading at $100 and earnings are coming up, or for whatever reason you want to protect that position. If you bought a $100 put option, the stock falls to 80, you have the right to sell the stock at 100. Now you wouldn't exercise that right. You would just sell your put option because a put increases in value when the price of the underlying falls. So you would just simply sell your put option for a profit and offset the loss on the stock. Do a quick case study. First on an individual stock and then on the overall market. Okay. Don't worry about the stock or the date. It's just a good example. So we keep the date. This could be any stock, especially with the run in the market that we've had. We have a lot of stocks that have a similar graph pattern to what you're looking at here. And now is the time that you need to be careful and protect yourself. So could be any stock. The scenario is this. You bought Texas Instruments in November due to the confirmed up signal. Maybe you bought it way down here on this confirmed up, all the way down at 85. Here we're saying you bought it right around 100, and the stock did exactly what we thought it would do. Okay. The stock's trading at 120. As of January, you have a gain here of an unrealized gain of 20%, roughly $2,000. Here's the way I want you to look at this. I don't own the stock down here anymore. Okay. It's in my account and it's trading at 120. That's what I own. That's my money. It's my stock. I don't want to give, listen, I know the markets will move and we can give some back, but I don't want it dropping all the way back here and giving back a large percentage of this. It's my stock and my profit. I need to be proactive. I need to be defensive. We have to recognize those times to be defensive. One of them, in this case, this example, because we do our due diligence on all our stocks, we would know that right here earnings were to be announced in about a week. So about a week to 10 days before earnings announcements, we want to go out and be proactive and become defensive. So we'd go out and we'd buy a put option. I would buy the right to sell Texas Instruments at $120 per share. That right would cost me $4.23 per share, or $423, just like an insurance premium. And if you're wondering, well, if it goes up, I'm going to lose some of that money, my answer is I don't care, right? I don't look at my car insurance when I open up my bank account and see that I just paid Geico the monthly insurance payment and I see that it cost me money. I don't get mad that a tree didn't fall on my car this month. It's the cost of doing business. It's the cost of insurance. It's the cost of sleeping better at night. Now, in this case, earnings came out and the stock gapped down, right? So you own the 120 strike at 423. It fell down to 120. I'm sorry. The stock fell down to around 100 and just under $110. That put option is now worth, just the very next day after earnings, or maybe that morning if it announced before the bell, is now worth $11.28. Right? It's roughly a $7 profit, 700 bucks. It mitigated or offset your damaged asset. Here's a quick graph just to show you. Before earnings came out, you had an unrealized gain of 2,000. Had you done nothing, you would have cut your profit in half. Still have a profit, but like I said, this was mine, not this. Because you bought insurance, you would have offset or mitigated that drawdown by 700 bucks, and you would have had a much less of a drawdown there. Okay, that's the power of the put option, and where a lot of stocks are now with large unrealized gains, it's the perfect time to go through that. Now, I won't ask you to type in, but if I were going to ask you, I really hope and believe that you guys would type in, I'd rather have insurance and sleep better at night when I've chosen to strategically defend my portfolio versus doing nothing and hoping that everything works out okay. Okay, that's what I'm going to guess. Yeah, a couple of folks are typing. Thanks. Okay, that's for individual stocks. Let me talk real quickly about a way to do this on your overall portfolio. Right? We talk a lot about where the VectorVest market timing indicators are signaling historical highs. Perhaps an overbought market doesn't mean the market's going to crash tomorrow, but we begin to become strategic. We begin to prepare ourselves for the next drawdown, which will come. It will happen, believe it or not. I created this slide back over just about a year ago, I guess, actually just a little over a year ago. I was creating it for a separate presentation about preserving capital and using puts on the S&P 500, specifically the SPY, which is the ETF that tracks the S&P 500. And the point I was trying to make was that, yes, this market is running tremendously to the upside. But don't talk to me about this run in the market unless you remember what happened back in 2018, October of 18. I know in this day and age, October of 2018 seems like an eternity ago, but we had a huge drawdown from October right up till Christmas Eve, which took almost a year. Now it did pop up above it, it pulled back, but before the next rally came, it took a year just to get your money back if you had done nothing. Okay? So this is what I'm talking about when I say we have to be prepared. Now this is the current. I took this screenshot actually today. This is the February pandemic sell-off, and this is what the market is doing. Now I'm not saying the market can't continue to rise and we can take advantage of a rising market and own good quality stocks. I'm saying you have to be prepared for this because we're talking about your net worth. We're talking about your retirement. This is not a GameStop trade on Robinhood. So you have to be prepared. So I've zoomed in. So this is the SPY back in October of 2020. This is a theoretical here. This one's not, although we did have some nice hedges in place, but this is just a theoretical look at what you could have done. We have a timing system on the overall market called the DEW. It's an acronym. And it went down on February 24th of 2020. It's a great signal, a great time to become defensive in your portfolio. Okay. One thing you could do is buy SPY puts as an insurance policy. Again, it's the ETF that tracks the S&P 500. We also had the confirm down, which is the final line in the sand. You better do something here. Otherwise, you're just, you're hoping that the market goes back up. Right? I say act on the DEW. You better act on the confirmed down at least. All right, zoom in again. Here's puts for your entire portfolio protection, a theoretical trade. DEW goes down. Okay, good time to place a put option on the SPY. We were starting to get news about the pandemic. It's not related to that. This happened in October. Could happen anytime for any headline. Okay, we don't need to know why. All I need to know is that there's red triangles that are telling me the DEW system is down. You go out, you buy, and I'm just going to use one put option for this example. The SPY was trading at 322. Buy the right to sell the SPY at 322, and you pay $9.75 per share, or $975 to protect your net worth. Maybe you buy two or three contracts. Three contracts would be just under 3 grand. Maybe your portfolio is 150, 200 grand. I don't know. But that's not a lot to pay at the right time to protect your portfolio. What happened here is that the market went down, and theoretically that April 322 put option is now worth $71 per share. Okay, that would be 61 bucks or 6 grand that you mitigated that drawdown from that I showed earlier. Okay. Now I did the same thing. I'm going to go through this one quickly because I want to get to a couple of other points. If you had done it on the confirm down, you would have been a little later to the party, but you still would have protected your portfolio and had a nice return. Again, an insurance policy to offset the damage to your portfolio. So earlier when I was showing the ruler stock portfolio and I mentioned these drawdowns, right? These returns don't take into account the hedges that we put on here. Okay. So these returns are even better when, again, we don't have it documented right in this portfolio, but just know that we were able to hedge against those conditions. Okay. Which are the three core strategies, right? And we talked about it. Ruler stocks, that's our growth portfolio, 34% return, nearly doubling. We talked about allocating for dividend growth stocks, right? We said when we added the payouts, we have over 24% better than the S&P over the same time frame. I talked about the AMD trades. Whoops. Sorry. I talked about the AMD trades where with just one stock we had over $7,300 return. That's just one out of 8 trades out of 38 trades that we did. Okay. And then again, the mitigation. So I'll end where I began. When Dr. D told me, he said, James, just tell him to keep making more money. Okay, that's the idea. So with that goal in mind, it's with that goal in mind that I invite you to attend the Ultimate Retirement Solution online course. I said earlier, if you wanted to learn more, a lot of the techniques that I talked about here today, I'd like to invite you to the Ultimate Retirement Solution course that we will be launching this week. Let me just take 2 minutes to explain the Ultimate Retirement Solution course. It is found in the VectorVest University, and it is recorded modules, and we also have live sessions and a lot of bonuses that go with it. Let me quickly just walk through each module. Win before you begin. We say it is of the utmost importance to have your objectives laid out, have clear goals set, otherwise you won't be successful. I talked about ruler stocks. We'll talk about the stock buying checklist, allocation, and setting up the risk management plan. Module 3, we shift gears and do the same thing. If you determine, again, you don't have to allocate to all three of these strategies. You may just want growth and the buy right portfolio, the income. You may just want, you're at a place where you just want steady income. You build a nice dividend portfolio, get some capital appreciation, as well as covered calls. But that's what we'll do in the first three. Module number 4. Again, I gave a quick introduction or tutorial to the covered calls, but we will go through step by step what, when, and how of covered calls, the proper setup and the proper trade management. We'll go into great detail on those. I've said it several times, probably the most important module in my opinion, because what good is making money if you can't defend it and protect it? at the right time. So these two modules are worth the price of the course, in my opinion. Just right here. And then the last module will help implement. Well, again, we'll talk about allocating funds, automate some portfolios, have some checklists, and wrap it all up. Okay. Now, there's a lot more that goes with this. These are the modules that are found in the university that you have access to a full year after you sign up for the course if you decide to. But here's what you get along with that. What we call 6 live mastery support sessions. And I'll give you the dates, but every Monday starting March 1st, we're going to meet at noon Eastern Time and go through each module, each key principle in every module to help you implement what you learned in that module. We'll help look at what you're doing. If you can't make it, don't worry. We have a dedicated email bin, a separate email bin that you can submit questions, and then you can watch the recording because we archive it in the university. Here's one of my favorite things. Again, I mentioned a couple times the Tuesday retirement coaching group. We have a large group that meets every Tuesday. We go over live portfolios. We update them. We look to see if there's any initiatives we have to take to be defensive. Okay, we go through those portfolios, and then we have a very specific, strict process for our weekly covered call income trade that I showed you. That's the covered call for the income portfolio. That's what I showed you on the spreadsheets. 80% winners, 25% return, using just about 50 grand. It's not like you need 400 grand in your account to do it. Right? With 50,000, you're able somewhere between 50 and 60. We have about 55 grand, I guess, if I round it. Okay. That's just doing the weekly covered call. At the end of the modules on April 12th, you'll have a bonus module. Our friend and colleague, Mr. Ron Wheeler, our options coach, will come in and talk about trading credit spreads for a monthly income. So you can take it to the next level if you feel comfortable doing that. It's a great session, and Ron will present that. And that's also a bonus. If you're in the room and you're new to VectorVest and you don't currently have a subscription, we will give it to you for the life of the course. You'll have 60 days access to VectorVest. It really is the best tool to determine market direction, and as I showed you, how to find the right stocks, and it just save you a heck of a lot of time. If you did all those separately or a la carte, as they call it, or whatever you want, it costs you a lot of money to do that. Okay, these are the values, about $2,500 to do all of that. Okay, but because you guys were kind enough to be here today, if you want to sign up, and again, John and I will stay here for as long as there's folks in the room and answer any questions that you have. But if you want to sign up and you order before, and you have a little while afterwards, by the way, order soon, either during the webinar or at the end, and you'll get a bonus. So the regular price, or I should say the regular price is $9.95. We have what we call an early bird special of $5.95. But because you guys were kind enough to come and stay through the presentation, you have some time, in the next hour or two. Go to this website, VectorVest, www.vectorvest.com/URS. John has typed it into the chat box, and you can click on that, and I'll do that in just a second to walk you through how to do that. But it's very easy. Click on that, and it'll walk you through the registration page. $4.95. That's one AMD trade, one MU trade. It's one protective put when the market goes against you. Right? We had 34 winning trades. If you're on the fence about it, here's a very important part of this. We are confident that you will build a foundation, you will be satisfied. Because if you're not, we will give you 100% of your money back. Take the course, show up, do the work. If you're not satisfied, if you don't think it built a foundation and gave you what we promised you, we will gladly give you a refund. Okay? So, that's a big part of this. They say there's no such thing as a risk-free trade. And actually there is in this case. Take the course, learn, build the foundation. If you don't like it, it's risk-free because we'll give you your money back. So the question I ask, or more importantly, you should ask yourself is how much is it costing you not to do this? I mean, you guys are here for a reason. If you're managing your money, your net worth, what will it cost you if you do nothing? If you keep making the same mistakes, how much money will you lose? How much potential profit do you miss out on? How much time and energy will you spend trying to do this on your own? I talked about the collar trade that we talk about in the course. I just placed one on one of my own stocks in my account. I sold a call, took that money, put it towards a put option, and the stock was down a couple of bucks today. It's amazing. It's like nothing happened to the stock. It was an insurance policy that covered about a $2 move on the stock today. So I do try to practice what I preach here. It's never too late. They say the best time to plant an oak tree is 20 years ago if you want to enjoy the shade. What's the next best time? Today. Join the Ultimate Retirement Solution. John and I would love to walk you through it all. You get access to the course for 1 full year, by the way. All of the resources, all of the videos, everything we do live is archived, and everything that's recorded is there. You get a full year money back guarantee, and it's only going to cost you $4.95 if you go to that number. And then I will just show you quickly. These are the live sessions. They're at noon every Monday starting March 1st, right up through April 12th when Ron will give the live bonus sessions. Okay. So there's a lot of resources, a full year of access, a dedicated email bin, live sessions, live coaching group sessions, 6 of them for the life of the course, starting on March 2nd. Okay, all for just $4.95. Okay, I'm going to take a breath for a second. John is here. We're going to go through, and thank you for the folks who are still in the room. We're going to answer any and all questions that you have about what we talked about and about the course. Okay, let me take a sip of water and I'll invite John in and we'll answer any and all questions. How you doing, John? I can, yes. I was just taking a sip of water that I muted. So. Okay. Yeah, that's a question we get a lot, and the answer is this: the first 4 modules that I showed are applicable no matter where you are, Canada, Australia, the UK, Europe, it doesn't matter. Okay. Um, I do say this though, in modules 5 and 6, when we start to talk about options, the U.S. Option market is a little, well, not a little, it's more liquid, it's more active than some of the other markets. Doesn't mean you can't sell covered calls. I know in Canada and in Australia, there are and everywhere, there are major companies on the list that you can sell covered calls against and also be able to buy protected puts. It's not like we're buying these, remote stocks that no one's ever heard of. All of what we do is usually in the mainstream there. So that's the one thing I do say is that the foreign markets, foreign to US, are sometimes they're not as liquid in the option world. So, but otherwise, everything else applies perfectly. Yes. Yeah, let me go ahead real quick. And while I'm doing this, if you've already gone and you signed up, do us a favor, type in that you're in. Type in that you've signed up. Just so we know, we can tell you what to expect. You'll get an email with all the instructions that you need. Again, you have some time. That 4.95 price will be up. And look, when you go in there, Adam is even here ready to answer any questions that you might have. It's live. So we're in the live stream here. So as I said, the price is 9.95. This will be up for a couple of hours. It'll change to 5.95, and then on February 23rd it'll go up to 9.95. But you can scroll through here and you can see all of the information that I've given you on each module. Right, a lot of great information there. You can hit purchase course now, and it'll walk you through um, signing in and doing what you need to do. Okay, so that's how we get in there. That's how we sign up for the course. Right through that link that John put in the chat box, and it's just vectorvest.com/URS. Okay. All right. Mm-hmm. Oh, it sure can. Yeah, it sure can, and it's a great question. But what we do, as I said, when you're in the university at VectorVest.com, where the course is located. All of the resources are there. The modules are recorded. Our live mastery sessions are recorded that day, and a couple hours later, they are archived into the university as well. We have other resource videos there. Let me go real quickly in here. So the short answer is everything we do is archived and saved for for you have access to it for 1 full year. 1 full year that you have. So let me see if this. So I'm just signing into university at vectorvest.com. I just want to show you real quick what it looks like when you have access to the course. So naturally, I have access to all of the courses because I work here. So here's the Ultimate Retirement Solution course. So when I click there, here, and there's Adam again to help me out. Here, right up here, there's a welcome video. Then there's each module, right? Build your growth, dividend portfolios, income, strategic defense. These are all saved in here, right? The presentation, we have homework, we have the videos that go with it. This is the live mastery session. So if you sign up now and tonight you go into a mastery session, it's going to be from the last launch. But what's going to happen is on March 1st in the afternoon, right? The mastery session from that day will take the place of the older version. So all of these are here for you. We even have a live stream. We did a 1 day live stream of the entire course. And you have access to that too. Okay, here are the bonus modules, and then we have other resources here. And again, you will have access to the to the group coaching sessions, right? So if you can't make any of the live sessions, this is my long-winded way of saying you don't miss anything. You'll see everything that we do. We have the slides, we have cheat sheets, everything that we use in each module is right here for you. And that's all found at university.vectorvest.com. So hopefully that helps.
Hey Jim, just to confirm again, when are the live sessions, including the coaching group sessions?
Yeah, well, I don't have the coaching groups here, but I can tell you here are the live mastery sessions starting on March 1st at noon Eastern Time. And it will be every Monday for the next 7 Mondays. No holidays or anything getting in our way. So every Monday will be the live mastery sessions. Again, we go over the module, right? There's a module that you watch, there's the actual lesson that is available. If you sign up now, you'll have access to everything I just showed you. Then on Monday, March 1st, we'll do a live session to go through each key principle and review and learn. I don't reteach the module here. We review it and we implement it. Now, the coaching groups, I don't have it on here, but it works out because the coaching groups will be the next day. Every excuse me, every Tuesday, and I don't have it on the slide, but every Tuesday at 2 p.m. Eastern Time. So every Monday will be the mastery, every Tuesday for these 6 weeks will be the coaching group, right? That you'll be invited to. And again, if you can't make it, as I just showed you, it will be archived in the university. A lot of resources here, folks. Access to a year with a full money back guarantee. Okay. Just the covered call module itself, I think will be a big help for you. What else we got, John?
I'm looking through, I don't see anything that we
Yeah.
haven't already answered in
Yeah.
there.
Okay.
Just see a question that just came in from Gordon. Do you see that?
Yeah, I do. Gordon asked, do your students tend to trade and make some profits during the course itself? Um, well, Gordon, listen, we want to make sure we do want you to get results quickly. We want you to apply this quickly, but you have to do it the right way. You have to feel comfortable. So we'll help set up in each module. Like I said, module 2 is where we really hit the road running, building our growth portfolio and the dividend portfolio. And sure, we'll walk through the covered call. And the great thing about this course, and we invite you to this extra session in the coaching group, where every Tuesday we actually, again, assuming there's not red lights and the market's crashing, assuming that there's an upward bias in the market, we do our weekly covered call trade, and I'll walk through um, all of the techniques and the process that we use. So certainly you can do some covered call trades based on that right out of the gate, as long as you're comfortable with them. I don't like to rush people, but if you're comfortable, and I think you will be, if because we walk through it in great detail. So Martin says, "Okay, I'm in. Fantastic, Martin. Good to have you. We look forward to it. Just keep an eye out, Martin, for an email that will come to you, not right away, but pretty quick, and it will give you all the instructions you need to get you going and get you into the university and access to the course." Oh, and Martin's in the options paycheck as well. Great, Martin. Yeah, you'll be able to handle your equity portfolio as well as your options, and you're well on your way to building and protecting your net worth. It's fantastic. Alvin, real quick, while other folks are, Juan says he's in too. Fantastic. Thank you, Juan. Alvin had a quick question here. Discuss relative safety versus dividend safety. Are they in essence the same? Alvin, no. Well, they're the same in that they're assessing the safety of a specific subject. Relative safety, as I said, is the determines the what it's determined by the consistency and predictability of financial performance. Okay, it has a lot to do with, does the company make money quarter over quarter, year over year, good balance sheet stuff, good fundamentals, making sure the stock is safe. We talked about company size, price behavior, dividend history, things like that. Dividend safety is very specific to dividends. DS is dividend safety, and it talks about, okay, you're paying me a dividend, but how safe is it? And the way I broke it down earlier, what we would consider an unsafe dividend is from a company who makes $1 per year on earnings per share and pays a $3 dividend. That's an unsafe dividend because you can't sustain that. Okay, so that's the difference. So they are very specific to uh, different particulars there. So hopefully that helps, Alvin. Gordon, you are welcome. Juan said he's in. Fantastic, Juan. Like I said, keep an eye out for that email. Costa, if I'm saying your name right, it says, I'm confused about the price. Is the 495 on top of the 2495 for the year? Costa, I'm not the 2495. Are you a member of the coaching group already? Would be my question to you. No. Okay, so the 2495 is it has nothing to do with what we talked about. Well, we we implement the techniques, but it has nothing to do with the course that I'm talking about. So 495, the $495 gets you 1 year money back guarantee access to the Ultimate Retirement Solution course, teaching the modules I just went through. Okay, what you're referring to, the 2,495, is to actually join the coaching group. So don't worry about that now. We'll talk about it at the end of the course, but well, let me just give you my email address. If you want to learn more about that, you can always shoot me an email, and I'm happy to talk to you about it. Just, whoops, that should say .com. CIN instead of COM. But that's my email address. I just typed it in there. If anyone has questions, listen, I'm happy to answer them. Be patient with me because a lot might come in now. But that should read VectorVest.com. It's been a long day, and I'm not the greatest typer in the world. I know how to spell, I just can't type. Jim P at VectorVest.com. All right, still some people in the room. I'm going to wrap up soon, but like I said, John and I will stick around for a little bit longer. If you have any questions, uh, if you're in, let me know that you signed up. And again, you have some time. If you need to think about it, you can go to this link vectorvest.com at ur slash I'm sorry /urs. That 495 price will be available to you. So if you're still here in the room and you're considering, again, it is risk free because I'll give you your money back if you're not happy. Robert says he signed up. Fantastic. Thank you, Robert. Keep an eye out. Remember, keep an eye out in your spam or junk mail too. Sometimes it goes there, but you will get the information. Martin, I forgot to mention earlier. It does include Profit Locker Pro. You do get the Profit Locker Pro software because we do use it on some of our management techniques. So you will have access to it during the life of the course, and then you can determine if you want to continue with it. It is an add-on, but you do have access to it for the duration of the course. And Martin says he got the email. Fantastic. So yeah, it gets out there pretty quick. Derek, yeah, even if you already have access, go to this link, vectorvest.com /URS, and go ahead and sign up for the course. Um, you know, especially if you're already a subscriber, it'll get you signed up, and like a couple of the folks already said, they got the emails already, giving them the instructions to get into the program. Okay, I'm going to give it about 90 seconds more. If there's any comments, questions, concerns, we'll answer them, but I'm just going to get ready to wrap it up here. Now, for those who are still here, you will get a recording of this. And as I said, the 495 will be available throughout, a good portion of this evening. Okay. So if you need to think it over, you still have time to go in there and take care of it. Eleanor, thanks for taking the time to be here. I certainly understand when the time's right. We look forward to having you as part of the group. But if there's anything we can do, of course, let us know. But hopefully, we'll see you in the next one. All right, folks, I'm going to go ahead and wrap it up there. Give product support a call if you have any questions. Again, I tried to put my email in there, Jim P at vectorvest.com. You can just send me an email if you got a question about the course. Um, and again, go to the link, vectorvest.com /URS. It will give you a lot of the information about the course there, and you will have access to that 495 price for a good portion of this evening. So I do strongly urge you to take advantage of it. It is 495 on a money back guarantee. When we're talking about building and protecting your net worth, okay, I talked about insurance and how important it is. Think of the 495 as an insurance policy, right? I was showing numbers 32% or 34% annualized rate of return for ruler stocks. 25% annual return we had in 2020 just selling some covered calls. Okay, if 20, 25, 30% annualized over a period of time is not enough, then you've been reading too many of the GameStop and Reddit and Wall Street guys headlines. Bruce, if you're looking for just a 30-day trial for VectorVest without the course, you can give product support a call. I think it's $9.95, I guess, for a trial. You do, if you take the course, you do get access to VectorVest for 60 days. So for the life of the course, you will have access to the program, and then you can decide if you want to continue with it after that. Okay, vectorvest.com /URS. That should read Jim P at vectorvest.com if you have any questions. On behalf of John, myself, and VectorVest, thank you again so much for taking the time to be here. You can still ask questions, call product support, give me shoot me an email. Please stay safe, stay healthy, and we look forward to seeing you next time. Thanks, everyone.